Welcome to the second Theta Live. My name is Jon Sandman and I live in Norway, where I worked for many years as a journalist and communications manager in Scandinavia's leading media company. And I started Theta Profits 1 year ago, and the primary objective has been to introduce options traders to different strategies and approaches to options trading. And this Theta Live is an extension of this effort. Today's topic is weekly options strategies. This is going to be a very interactive session with most of the time spent on your questions. And we have 3 guests, and we might as well start and bring them in. Let's see. From New Zealand, Simon Black. Welcome, Simon.
Hi, how's it going?
Or good morning, we should say.
Yeah, morning time here.
Yes. And we have our second guest from California, Steve Ganz.
Oh, nice applause. Hello, Simon.
Good afternoon to you. And then we have one more guest. Ravish Ahuja from New Jersey.
Hello. Hello, everyone.
All of you have been interviewed on Theta Profits before, and these have been very popular interviews, all of them. So I was very happy we could bring you guys together. And let's just take a very quick round of introductions first. And I think we will just start with you, Simon. Who are you? In 1 minute.
Well, I'm Simon. I'm an options trader. I'm based in Wellington, New Zealand. I've been trading options since about 2007. And I specialize at the moment in these short-term weekly option strategies.
All right. And let's move to California and Steve Ganz.
Hello, everybody. So, and these funky glasses are eye strain glasses. I had some eye surgery and I'm still working through it. So just go with me on that one. But anyhow, I have been a stock and options trader for 30 plus years. I have been an educator for about the past 15 years or so, teaching live classes pre-COVID. And then during COVID, I was forced to teach online, really liked it. So now most of my teaching is online.
I'm Ravish. I'm an options trader. I've been trading options for 9 years now, and I specialize in options income strategies. I'm based in New Jersey in US.
All right. So all 3 of them will very soon give a short presentations of how they trade their weekly options strategy. So let's just test this now with our first live poll. If you choose the poll, there is a question: which single word best describes what you expect from today's Theta Live? So if everyone now find one word, you can answer many times, but one word at a time, and just put it in on this poll in the app, and we will bring it up in here soon. We are all right. Not many people have answered yet, so let's get some more responses from you guys. Steve, any comment to what you see on the screen?
No, I like it. I do think, adjustments obviously is a huge question for people, and it's a little tough to get too deep into adjustments in a short amount of time today. But, and with, at least with my Flyagonal, it doesn't require a lot of adjustment. About 60% of them have been unadjusted at this point. Obviously, that can change with market conditions.
All right. So I see we have a lot of answers now. One last message. All 3 panelists do sell some courses or services connected to their trading. Theta Profits or me have no commercial agreements with either of them. That's a typical question I often get. So there is no commercial agreement in that. But if you want to explore any of their offerings, there will be a contact link for each. There is a contact link for each of them in the description on YouTube, and it will also pop up on the screen when they are presenting with the QR code. But other than that, we're not going to talk about the commercial offerings they have in this event, neither in the Q&A or in the presentation. All right, I think we will finalize this word cloud now. Knowledge is the most biggest word right now, and that I think we will try to answer. The first person to present will be Simon.
Great.
Go ahead, Simon.
Yeah, so I've just prepared a little slide deck to talk through, just so I can keep on track for that sort of 8-minute time slot. So I'm talking about today about the trade I call the Timeflies Spread. Like I said in the start, I made the slide just to say a little bit about me, which is exactly what I just said. I've been trading options since 2007. I'm in Wellington, New Zealand, and a lot of people who aren't or haven't traveled don't know much about New Zealand. So I thought, here we go. This is New Zealand. I'm right in the middle. That's the capital city, that little red square. If you didn't know about anything about New Zealand. And this is what my home city of Wellington looks like, in case you're wondering. It looks like a CGI picture, but that actually is where I live. Anyway, so I thought I'd do what John always asks in his interviews. He always asks people for that 40-second overview sales pitch, or whatever you want to call it. So what is Timeflies Spread? So it's a defined risk short-term trade. And of course, this whole point of this talk is about weekly option strategies. My trades last about a week. It's a delta neutral strategy. I'm not trying to predict market direction. If anything, I want the market to not go anywhere, which is what a delta neutral strategy is. It has some built-in handling for volatility expansions and contractions, which we'll get into. One thing I like about this type of trade is I only need to check it once a day with my time zone. It's morning time here in New Zealand. It's Thursday morning. I'm asleep for the first half of the market. I can't be at my screen all day. I've got kids. So being able to check once a day suits me. And I'll just say up front, it's an intermediate to advanced strategy. So this isn't suited for complete beginners. And I'll go into why that is in a second. So what are the components? Straight to it. It's pretty simple. If you've seen the other video interview with me, you know this. It's a put diagonal below the market price and a call broken wing butterfly above the market price. Now, a diagonal is probably, you'd consider maybe an intermediate strategy, and you probably consider maybe a butterfly an intermediate strategy. So overall, put them together, you could say the whole trade is intermediate to advanced. I wouldn't say a diagonal is a beginner's strategy, for example, which is why this overall trade you'd say isn't really for beginners. A really quick overview of diagonals. This isn't, I saw the keyword on the poll was education. There's plenty of ways to learn about diagonals, but it's a trade that combines both the calendar spread and the vertical spread. It has a directional bias. So in the case of a put diagonal, which is what I do, it's a bearish strategy. You want the market to fall. And the Greeks are really important with this strategy. So diagonals are theta positive, so they benefit from the time decay of that short near-term option, and they're vega positive, so they benefit from a volatility increase, and that's due to that longer dated option. So what I have is I have a little video I've made. I pre-recorded it in OptionStrat because I didn't want to fumble with it. So just going to switch screens, and you can see this is a diagonal. You sell a put and you buy a put, and the difference is different strike and different expiration. So this one lower down is slightly later in time. Just going to play this video. It's only like a 20-second video. I'm going to drag the time slider along, and you should see the curve pull up because it's theta positive. Then I'm going to stop and drag the vol slider up to show you that it's vega positive. So just watch very carefully. I'll play this. You should see as time moves forward, the curve moves up, showing diagonals are theta positive. And now I'm going to, I pre-recorded this now, I drag the vol slider up, and you should see the overall sort of tent rise. So a diagonal is theta positive, vega positive. So that's that. So we'll come back over here. So broken wing butterfly, it's a slight variation on a normal butterfly. It has a slight directional bias. It's not quite the same as a diagonal. In the case of a call broken wing butterfly, it's sort of bullish to neutral. And with the Greeks, it's theta positive to neutral. It kind of depends where the market price is in relation to the tent, but you'd say it's theta positive. It's Vega slightly negative, and it benefits from volatility decreases because as vol drops, it's cheaper to buy back the short options. So I had another video of a broken wing butterfly. Here's a broken wing butterfly. Here's the market price. This is the 10th above. Same thing. I'm going to push play. As time slider moves along, you'll see the curve pulls up. It's not going up as much as the diagonal, but it is theta positive. And now, in a second, I'm going to drag the vol slider down. It will show you that it's Vega negative. So now drag the vol slider down, and then it pulls up. So that's that. So the question is, put them together, why does this work? Well, the put diagonal benefits from a volatility increase, as we talked about, but volatility normally increases on a market drop, and the diagonal is below the market. So we want that drop. And then on the other side, the call broken wing butterfly benefits from a volatility decrease. Volatility decreases normally on a market rise, and the broken wing butterfly is above the market. So we want that rise, right? So putting that all together for the final video, here is a basic Timeflies spread in SPX. And basically you can see a diagonal below the market, a broken wing butterfly above the market. And again, I'll push play. I'm going to drag the time slider along. The overall curve rises up. You see, so in the middle, it's high because it's delta neutral. You want the market to not move. And now in this video, I pull the vol slider down. So imagine the market's drifting up and the vol's decreasing. Now the curve sort of tends to the upside where hopefully the market is gone. You're up in this area here, and reset the vol slider, and now you drag it down. Imagine imagine the vol's increasing, market's dropping, and now you're down here. So that's kind of the overall kind of trade. And just to round out the last couple of minutes, I've got some quick notes here. Instruments, I personally trade this. I have traded it with SPX. This year I've been doing completely on the Russell, RUT, but other instruments are possible. The buying power, like any trade, depends on the instrument and your risk tolerance. Because you've got widths and diagonals and butterflies, you can make them use more buying power or less. For Russell, I aim for $600 to $1,200 per contract, and that's just me. I like to exit when profits reach 10% of buying power. That's sort of my goal. And adjustments. So like Steve said, adjustments are possible, but there's a bit of an art to it, and it's really hard to fit it into a short time frame. But given that you're trying to be delta neutral, that's sort of one of the hints, right? If you're going to delta too much one way, you might want to consider that. And I thought I'd quickly just talk about my results. These are on my website. You can have a look, but I'm at about 85, just under 85% for the year. This is the per contract profit for the year. And I thought I'd show you here. I said it's a weekly trade. I'm in the trade at average 6.1 days for the year. And something interesting as well, you'll see the average loss is actually much bigger than the average profit, but with an 85, 84, whatever % winning rate, that doesn't matter so much. And then the average, I said I'm aiming for that 10%, of buying power, and my average for the year is 8.1. So that sort of shows you that 10% kind of thing I'm aiming for. So that's pretty much my little presentation. And I think I actually set a timer here. That's almost exactly 8 minutes. So hopefully I did okay, John.
Fantastic. Fantastic. And we have started a new live poll in the, oops, that was the wrong, in the meantime. So let us just look at that. The question we asked is, what type of weekly option strategies do you trade? And you can still answer, so we get the full picture. You can give us several alternatives. Of course, I guess not everyone is trading just one strategy here, but it's good to have an idea about what the audience is actually trading. Ravish, do you have any comment on what you see here?
Credit spread looks like the most popular strategy. It is what everyone starts with, and it works well if you can time the direction of the market. But yeah, and surprised to see a lot of people trading double calendars as well.
Anyone else would like to comment on what people trade? No, but it seems like most people in the audience at least are trading at least one weekly strategy. It's only 10% as far as I can see that do not trade a weekly option, which is maybe not so strange since you have actually signed up for this for this event. But this gives us a small an impression. Credit spreads, practically speaking, half of you trade that. Double calendars, other strategies, custom setups, etc., etc. We will bring this one out. You can, of course, continue to answer if you like. But now it is, we are moving over to Steve.
Okay, let me get my screen up here as well. Are you seeing my screen here okay?
And now we see it.
Okay, perfect. So first of all, I want to say, interesting story between Simon and myself. I saw his interview on your channel here, John, and I'm like, what the heck? How did this guy find out what I was working on? And I gave him a ring. We had a great chat, and he didn't find out what I was working on. It's just great minds think alike. And I almost don't even need to do a presentation because he kind of nailed a lot of it, and we're very, very similar in the way we're approaching things. So let me just kind of go through my presentation here. So the one challenge that I think most traders have often had is consistency. I know even for me, after trading 30 years, I mean, I would be up 100% in my options trading one year, and then maybe I'm only up 20% the next year. So it was difficult to get that consistency in there. And in this particular strategy, what I specifically like about it is I've taught multiple classes. When I used to teach live classes, I taught mainly the butterfly strategy, and then I would teach the diagonal strategy. And as I do those classes, each of these have certain strengths and weaknesses. And I'm starting to realize, wait a minute, these offset each other. These two balance each other out, which Simon so adequately demonstrated. When the market goes up, volatility usually drops a little bit. That's perfect for the call broken wing on the upper side. When the market goes down, volatility usually goes up a bit. That tends to be great for a diagonal sort of strategy. So I started noticing that these two blended really, really well together. And should they be traded together? So what I did, took a slightly different approach here in that I used a lot of AI. I started going down the AI rabbit hole about a year ago. And I started having AI analyze all these trades and different variations of them and how could they be modeled and put together. And I think it's helped me immensely. So I did about 6 months of what I'll call back testing or theory testing. And then in May of this year, I started trading it live, smaller size. And so those trades have generated $30,000 in profit. On average, I only have a total of $20,000 in capital deployed. I may have 4 trades, usually 2 to 4 trades open at a time. Right now, they're minimal size for my students. I'm predominantly trading SPX, but I've also traded almost everything else: SPY, IWM, Russell to some extent, Tesla, Google, etc. But about 150% return over those 6 months. I've done 122 live trades. Right now, I'm at a 95% win rate on those trades. So I've just been really kind of blown away by how well this trade has held up. And I kept telling my students, you know, guys, we can't expect this to remain this way. I've never seen a trade hold up as well as this trade has. And I kept telling them the other shoe's going to drop, the other shoe's going to drop, and it may. But right now, this trade has held up really well. So the next few slides are literally, these are just all of my live trades. Every trade I make, I use a product called Option Trader's Assistant as my trading platform, and it generates these types of reports for me. So I can see, again, pull reports like this to show every single trade. I want you to see my losing streak, and I'll enlarge this just a slight amount here. My losing streak happened right here. And in typical trader fashion, what we do is when something starts working really well, of course, we all size up. I think everybody knows that. And then you size up right at the wrong time. So in this particular case, I sized all of my trades up. I did I think it was a 3x or a 4x, what my normal trading size was. And I had 2 trades on that had the exact same complexion. And our market whipped down. I adjusted the trades to accommodate that down move. And then literally the very next morning, our market whipped back up 300, 400 points. So all of those trades were whacked fairly hard. That is my losers right there. But as Simon pointed out, even though the losers are bigger than the winners, when you have a 85, 95% win rate, it can handle that. So these are like 5 or 6 pages. This is every single trade, every single live trade that I've made. Again, you'll see I've traded the Qs, I've traded SPY, I've traded IWM, I traded NVIDIA. So I've used this on a lot of different underlying symbols at this stage, and it has worked very well across all of them. So the actual, and that we don't need to see any more of these live results. I think you get it, that it's been very successful. These are the overall stats that get pulled out of my trading platform. So for me, I said 116. I actually closed out 2 more here today. So I've had 118 trades, 112 were winners. Many of these are in my alert service, and we've had 24 winners in a row in there. My average days in trade is about 5.5. Again, we see that the largest loser is bigger than the largest winner, but with that win rate, doesn't make a big deal. So it's performed exceedingly well. This is the P&L curve of that trade. So this shows you kind of how the gyrations that this trade has gone through. This was that hiccup that I told you about where I sized up. What was really valuable about that, though, when that occurred, I fed all those trades into the AI tools that I've developed that help me in analyzing these trades. And I asked it the question, is there something differently I should have done? And it analyzed those trades and basically came back with the resolution that, Steve, you were adjusting too early. Okay, you adjusted when the market started going down, and then the market ripped back up the next day. Now, you could look at that, as long as I've traded, you could look at that and say, that's a form of curve fitting, meaning that you fit your answer to your data. But I will say that I asked it for an optimal time to adjust. It gave me the number 10%. When I'm down 10%, that's when it suggested 10% at the end of the day. Like Simon, I really only look in on these at the end of the day. If it's down 10% at the end of the day, that's when I want to start modeling or considering an adjustment. So far, these trades, 60% of them don't even require adjusting. So many of them are just put on, take off. But the fact that I had those to feed into AI, let AI crunch on it and say, how should you manage things differently? And then I implemented that going forward, and we can see that it had a fairly significant impact on the outcome after that. Now, this is a very short little 5-second video that I put together, and it's going to be almost the exact same as what Simon just showed you, but I love what the way this puts us in. In a nutshell, the fact that you essentially, I call the Flyagonal a theta bomb. The reason, in my opinion, that it and the Timefly is so successful is that you're getting theta from both sides of this trade. So you have almost double the amount of theta that you would have off of just a butterfly or off of just a calendar. And if you have double the theta and it's decaying as fast as it's decaying, that means that you have to be in the market a lot less time with just a lot less overall market exposure. So, oh, sorry, we don't want that in there. But anyhow, so at the end of the day, that's the Flyagonal. And I think it's, very similar to what Simon showed you, just a slightly different very slight nuances or variations there, but the concepts are the same.
All right. Thank you very much, Steve. And we put up out a new live poll. We are curious about how much risk can you take? If you take the slider here and go from the left to very conservative and up to the right, aggressive risk taker, where would you put yourself?
Is this for us, John? Is this for us, or are you asking your members?
I'm asking the members, and
Okay.
many of them have already said. So let's see. This shows only the average of the people who have answered, and then we put ourselves pretty much in the middle. I'm sorry, this one doesn't show the distribution, but I guess no one is surprised that people, on average, put themselves on the pretty much in the middle. How much risk are you taking, Simon? Are you comfortable with risk?
Yeah, I think I said 7 when I voted.
Yeah.
I wouldn't say above average risk, but I guess educated risk, I suppose I'd like to call it. Like I have higher risk on trades that I really understand. And of course I have lower risk if I'm experimenting with some new strategy, right?
What about you, Ravish? Oh, you have muted yourself.
Yeah, I am fairly conservative, so I rated 3 on this risk curve because I am more concerned about capital protection.
And Steve?
I feel that I'm pretty risk averse as well. I think that I think the question, John, probably needed to be a little more nuanced from my perspective. And are you talking specifically my options trading, or are you talking my overall portfolio, if you will? But either way, I'm to the lower end of the scale on risk tolerance.
Yeah, and I guess I would be too, if I am to be honest. All right, the next to present is Ravish.
Sure, thanks, John. So my
Should I bring in your slides?
Yes. No, I'm not sharing slides. I will give a small demo in options strat.
Okay, you want me to bring it in now?
Yes, I'm sharing screen. Do you see my screen?
Yes.
Okay, perfect. So my bread and butter strategy is calendar, double calendar, and also some diagonals. Now, the way it works is I typically like to have either a bullish view, a bearish view, or a neutral view. So if I have a bullish view, then I can go and make a calendar spread trade. So let's say SPX right now is trading at 6,800. If I think that, yeah, over the next couple of weeks, it's reasonable that we can go about 50 to 100 points up, I can go out and make a 6,900 calendar trade where I will I will sell an option which is about 2 weeks out. So in this case, I'm going to choose 21st, and then buy a call which is another 1 week out. So that's going to be first. So that's going to be 28. So there is like 1 week difference between both expirations. Now the great thing about this trade is it is risk defined. It has a lower chance of profit, like 38%. But in terms of profit, it can make, like, even if you hit bullseye, it can make 272% profit in 2 weeks. Now, most of the times I am not going to hold it till that level. But if within a week or so, I see 20, 30, 40% profit, I'm going to take that profit and move on to my next trade. And similarly, I can also do a put calendar spread if I have a bearish view. In that case, I can go out and make a put spread where I'm going to select the same dates, 21st, and long date is going to be 1 week out. And in this case, let's say I think SPX can go down 100 points. And now in this case also, my chance of profit is slightly higher. It's 46%, but I can make profit even if the market stays flat. And again, in this case, I have an opportunity to make well over 200% profit. Most of the times, I don't even get anything close to that. Most of the time, I'm happy with somewhere between 20 to 40% profit. But there have been scenarios where I have hit bullseye and ended up making like 500% profit even. And you can make these kind of trades for any duration, but for me the sweet spot is 2 weeks short expiration, 3 weeks long expiration. And it gives you like a good balance of how much profit you can make in a week or 2 weeks. And it is also lower volatility. If SPX goes down, up and down a lot, your trade is not going to move as fast. The longer in the time you go, the slower your trade is going to move, the lower volatility you have. I sometimes even make trades which can be 2 months or 3 months duration, because that gives me a lot of time that, okay, even if there is short term volatility, the market goes against me, it can eventually get on the track in another month or so. So with that kind of trade, I can set it and don't have to manage it day to day. It can go on for 3 months. And whenever it hits my profit target, I can take it. Now, if I do not have a view whether I want to be bullish or bearish, then I can make a double calendar trade. In this case, I can buy a put calendar and I can buy a call calendar. Again, I'm going to choose the same expiration dates, 21st and 28th of November. Now, in this case, it is going to give us a risk curve, a profit and loss curve like this, where you have like these two peaks. You make the most profit if market ends up at your expiration by if market ends up at one of your strike, either put strike or call strike, by expiration. But you have a lot of opportunity to make profit in between. So when you start, you are not going to start with a curve like this. Initially it is kind of flat, and slowly as you go into the time, you are going to make profit somewhere in the center. If the trade moves too fast to one of the direction, then you can be in a drawdown. But we really want the market to move slowly and stay within the range, and half somewhere around halfway through the duration. So if I'm going out with 2 weeks expiration, my goal is to capture my profit within the 7 to 10 days mark. If I can make profit earlier, that's even better. So by 10 days mark, if my trade is between my range, I can make somewhere between 5% to up to 30%. And I would be very happy with that kind of return. And I can make these trades week after week. Every week I can open a trade like this and go out further in time. I can do these trades on SPX, triple Q. Now, if you want to do this trade on individual tickers, you can only do it on some of the biggest tickers like Nvidia, Apple, some with the highest volume. And even there, you are going to have wide bid and ask spreads. And then those stocks can also move out of the range quickly, because one news comes out like last week, 2 weeks ago, I was in a trade on AMD. A news dropped that they are partnering with OpenAI. It shot up like 15-20%, and my trade instantly went into a loss. But that kind of scenario is unlikely to happen with SPX and triple Q. And but it can happen, so you have to be prepared for anything. Like just yesterday we had a 2% drop in Nasdaq. So things like that can happen. For that reason, the further out you go in time, the wider range you will be able to get. So typically I'm choosing somewhere between 20 to 30 delta. In this case, I have 27 delta for call, and I have a 25 delta for put. Sometimes there can be a little bit of skew. Now, if I were to go out in time, I can get a much wider range, right? So let's say if I want to make a trade which is 1 month out, I can do a short expiration date, which can be 5th of December, and long expiration can be 12th of December. So in this case, I would be able to go uh, a little bit further. So that way I can have a wider range. Now, when you make a trade like this in option strat or thinkorswim or any other tool, you will sometimes see that the chance of profit is very low, and you will sometimes see that there is no way to make profit in a trade like this. That happens because of volatility skew. Now, volatility is going to change over time. All the Greeks and IV is dynamic. It's going to change every minute. But when you model a trade like this in option strat, it assumes that everything is going to be static, but everything is going to change. So you can come here and play with this slider to see how it works. If volatility goes up, if volatility goes down. So when I enter a trade like this, I have to have some discretion where I see the volatility going. I either want the IV to stay flat or I want the IV to go up. Now, in this scenario, let's say if IV goes up, then I will be able to make more profit. If IV goes down, then even my best trade is going to turn into a loss, and there is nothing I can do about it. In that case, I'm just going to take a loss and move on. Now, the great thing about implied volatility is it's actually fairly predictable in most cases. Now, for example, if you look at VIX, the trading range for VIX for this year is that it has a mean of 17. Most of the time, you'll see that when VIX is under 17, it will go to 17. When it is higher than 17, it is slowly going to come down to 17. So that kind of gives me a range that, okay, I can enter a trade like this when VIX is under 17, and I should avoid entering when a trade is when VIX is over 17. So if I do that, then I won't be able to make a trade like this every day or every week, sometimes not even every month. When Trump made announcements about tariffs in April and May, VIX was elevated. It was over 20. It even went up to like close to 50. So for those 6 weeks, I did not make a single trade because I was like, okay, if I make a trade like this, I'm going to lose. So I used that time to focus on my long-term strategies. And yeah, so as long as you enter a trade like this with when VIX is under 17, you are going to have a better outcome. Now, not every trade is going to win, but my long-term win rate on this is about 85%. And I started earlier this year, I started a new account with $100,000 in capital. And this is the actual profit and loss from my real account, where you see this purple line is my account, which is it says is up 140% year to date. Now you will see that there are periods where it's completely flat. That's because VIX was high and I did not make trades during that period. And you see that there is very minimal drawdown on this trade. Now in this account, mostly I'm trading single calendar spread, call calendar, put calendar. I'm also trading diagonals, and I'm also trading double calendars. These are like my core strategies.
All right. Thank you very much. We started a new live poll. If you haven't responded, you can do now. What's most important to you in a weekly strategy? And you have a few alternatives, and you can select up to 2 of them. So let's see. And many of you have responded already. So let's see what you answer. This is how it is now. And consistent theta income and high probability of profit and defined risk is quite high. Anything you want to comment on this, Steve?
No, I think makes perfectly good sense to me. I like that all three of our things we trade are essentially defined risk. So I think we fit very well into the people that are attending here today.
That's good. Yeah, it's not a very surprising results, I think. All right, I will take this out and stop this poll, and we will go to questions. I want to remind everyone that you can actually wait a moment. We will need to get this many things. There we go. I want to remind everyone that you can vote questions up and down. We have a lot of questions, 34 questions, and we are not going to get through to them. To all of those. So be a little bit active, read through what other people have asked. If they are asking something you would like to have answered, put that in upvote. If there are some questions you think, no, this is just too dumb, you can vote it down. And I will, in general, pick the questions that are on the top I will also remind that you can actually, if you want to come in and ask question on the video, there is a way of cheating by going to this URL, and you will skip the line, so to speak, and be on camera. And actually, we will start with a question on camera, and I will going to bring in from Milan in Italy. Here we have Andrea. Hello,
Good evening,
Andrea.
everybody.
Hey, Andrea.
Hey.
Ciao,
Hey,
Steve.
Andrea.
Good evening, everybody. Good evening, John.
Good evening.
Who are you?
I'm fine. Everything fine from Italy. Buonasera, we should say.
But you are an experienced option trader that have been teaching options in Italy for many years, right?
Yes, that's true. And I'm really passionate about this magical instrument. So I couldn't lose this opportunity to hear some experience from our very high level top traders here, experiencing this very fascinating field of income trading. You know, Theta Profits really recalls of trying to get an income out of trading options as consistent as possible. So tonight it was really fascinating to me. I was familiar with these strategies because I followed your videos on your channel. I also had a chit chat with Steven. So it was really interesting, and I got a lot of insights from the three speakers, and I thank them for this.
And I
So there
will
would
just
be
reveal that in a week and a half, Andrea is the interview guest on Theta Profits in a very exciting and different topic. We are not going to reveal what that is now, but ask your question, Andrea.
yes. I'm really happy about this preview that you just gave, and I'm looking forward to that. I would have a million questions, but I would go with this. Slightly different between Stephen and Simon and Ravish. About Ravish, what I would like to ask him, since he posted a very impressive result in terms of percentage, and I congratulate him for that. I'm gonna ask you how he manages basically sizing up money management and risk taking. If he has a philosophy or a tool that allows him to scale up the size of his trades gradually while he has profits along the way. I'm really curious about that because the result is really impressive. Whereas to Stephen and Simon, I would like to ask them what Ravish just commented about, and I'm talking about the relationship with volatility. If there is any way they look at either the VIX or the real implied volatility on SPX or RAT to decide if a week is better for a Flyagonal or is worse for them, and if they maybe use the level of implied volatility as a tool to manage maybe size, or to maybe decide not to take the trade if volatility is too high or too low. The relationship between volatility and Flyagonal or time.
All right. I guess we will bring in Ravish first.
Yeah, for me, the way position sizing works is first of all, I allocate a fixed amount of capital to a separate options trading account, which is a small fraction of my overall portfolio. Now, with that, with any option strategy, I assume that there can be a black swan event at any time, and all your active trades can go to zero, regardless of whatever strategy you're using. Right? What should we do if market drops like 10% in a couple of days? Then I assume that it can go to zero. So my active position size is always going to be something that if it goes to zero, I'm not going to lose my sleep over it. And now, in terms of sizing, I like to keep it consistent. So, for example, on this $100,000 account, most of the time, majority of that account is sitting in cash. Uh, I look at two things. One, how much capital I'm allocating per trade. So, in this case, it's about 5 to 10% of the account. And the other thing is how many active trades I'm in and how much total buying power I'm using. Initially, when I started this account, I was very conservative at using about 20 to 30% buying power. But lately, I've been scaling up. And because now I have some house money to play with, so I can take higher risk. So now my average buying power usage is about 30 to 40%. Maybe sometimes it goes up to 50%. So, and this account has been making like 10 to 20% monthly returns compounded on the whole account.
Amazing.
Let's move to Simon.
Amazing.
Yeah, so the question about volatility and taking that into account, VIX, for example, I think in a way you can kind of compare these kind of trades a little bit to, most traders know about iron condors, which is a delta neutral strategy. If you imagine you're in a situation where volatility is high, it's spiked for whatever reason, there's been big news. If you were doing some kind of fixed delta option selling options at a certain delta, that iron condor would naturally be wider, right? And if volatility was low, it would naturally be narrower because the market's expecting to move less or more. And so what I do each week, and there's no sort of mathematical formula or anything to it, but I look at volatility. I just use VIX, even though I mainly trade the Russell, which has its own volatility index. Let's not get into that. But we have a feel for the market. Is it relatively stable? Is it crazy? Is it Liberation Day all over again? VIX is 40. Is it down to 15, 16, 17? And I just use that to sort of set the overall width, if you want to call that, of my spread. So where sort of the short strikes live. If VIX is quite low, they might be a bit tighter in. If VIX is higher, they'll be further out. It doesn't really matter so much because as we've discussed, volatility changes throughout the week, a kind of handled by the diagonal and the butterfly. But when VIX is higher, you want to give it a bit more room because the market can move more. So I sort of trade it like an iron condor in that sense.
And
Thank you.
Steve.
Yeah, I think Simon hit the nail on the head there, but I want to add one little additional piece to that. Much like as Ravish had mentioned it's better many times to put on those time spreads in lower volatility. You usually want to put on a butterfly in higher volatility. So the nice thing about the Flyagonal or Timefly is they kind of balance each other out. So where Ravish went flat for a period of time because volatility was high, and understandably, he knew to pull back on that. From my perspective, at least right now, with the Flyagonal and the way they offset each other, I've found them to work equally well across different volatility environments. But to Simon's point, when you do have higher volatility, just like in a condor, I can put my tents a little bit wider apart and give myself wider range to play in. So I think it's been a good universal trade where I don't have to wait for a volatility event to enter. I have found a slight hedge in putting on the trade when volatility's up a little bit. It seems that the drop in volatility maybe is a little more helpful to the trade. And many of my trades, much like Simon said, I'm usually out at 7 to 10%. If I can get 5% in a day, I take it and run. And I believe out of my 116 trades, I think about 30 of them closed the same day. I opened them up, volatility dropped. I was able to hit 4, 5, 6% in a day, and I just pull the plug and get out.
Really interesting. Thank you.
Thank you very much, and thank you for joining us, and Andrea for asking questions. And we will see you back on Theta Profits on Sunday, November 16, about trading options in a very different way than most of us do. See you then. Okay, it's time to bring in the questions from the audience, and we will start with the question from MK. Hi, Simon. Is there any specific reason why you switched from trading Root instead of SPX?
Yes, there is. Actually, if I was going to name one question that I get emailed about the most, it is this. And ironically, I actually talked to you about it in our initial interview, John, but it didn't make the final edit. I think we were just chatting about it, and maybe before. It's a really simple reason. I was happily trading SPX, no problem there. I was trading it slightly differently than what I do now, but my broker is Tasty Trade, and overnight they increased the buying power for short-term calendars to 100K per contract, which I was like, this is crazy because it's a defined risk strategy. I even emailed Tom Sosnoff directly, and we even had a conversation about it. And it was all due to zero DTE traders putting on these really short-term 0 DTE, 1 DTE calendars, and then the market dumping or something, and then there was some drama. So Tasty Trade changed their buying power. So I was like, that's it. SPX is out for me for the moment. I mean, they might change the rules. So I thought, well, I'll just trade something similar to SPX, which is the Russell. It's another index. And Russell's a different instrument, and it made me tweak how I do stuff. And in the end, my results were better with Russell. So I thought, okay, I'm not, no point turning back now. If you go back and watch this video again, you'll see the trade I set up to show the trade was SPX. And I know people definitely do trade this in SPX, no problem. It's just my current broker doesn't let me do it. I could have a second broker if I wanted to, you know what I mean? So yeah, there we go. Simple answer.
Steve?
John, quick comment on that. Funny enough, it's exactly the opposite here with Schwab. So I had been trading RUT and SPX. All of a sudden, I go to put on a diagonal with Schwab, and they're wanting $100,000 or some large amount of money set aside. So I guess I want to ask the question. I mean, they don't do it with SPX. And I called Schwab and I asked them about it, and they said, well, that's just a new rule we have for RUT. And so, Ravish, have you run into that with any of the brokers you use, since you're always trading a time spread?
So I mostly use E-Trade and Thinkorswim. I have not had any issues with that, but some people in my community have run into issues with some brokers like Robinhood, Webull, TradeStation. They are not allowing any time spreads on SPX and indexes because of the assignment risk. Because but you can make the same trade on SPY and Triple Q. The reason for that is if your short strike is exercised, then you basically have a cash settlement. You are long, and if it happens at like 4 p.m., by the time you are able to exercise your long call next day, the prices are going to change, and then you will be in a hole. So, which is why they are not allowing it on indexes.
You don't trade RUT though, do you, Ravish?
No.
Okay, see, because I can do SPX on all day long on Schwab, but as soon as I go to RUT, that's when they, and it sometimes they let it go through. It's really weird. Sometimes it goes through just fine. Other times I get this big warning that it's going to use a massive amount of buying power. So anyhow, I just thought I'd mention that, Simon, that it's weird that it's almost the exact opposite with Schwab.
What it tells me,
I have had the exact same experience as Steve with Thinkorswim. I am not able to do diagonals on RUT, but I can do them on SPX for some reason. We will move on to the next question, and we have a lot of questions. I will ask the gentleman to be as brief and concise as you can be, and I will ask the audience to keep voting questions up because we are only gonna get to a small portion of them. So choose which one you think is most important. So let's go to the next question, and that's from Nick McWan to Ravish. You said that you do not like to trade double colors with more than 15% of your count, and you complement with leap options as majority of your portfolio. Which other strategies that you recommend or suits along with double calendar that fits nicely along with double calendar, which can in fact help to compensate loss in case big moves like 2020 or 2008 crashes or melt-ups? That was some mouthful of a long sentence. Ravish.
Okay. So of my overall portfolio, more than 80% is deployed into long-term just buy and hold investments or long-term option strategies. And I only use active strategies like double calendar with about 10 to 20% of my portfolio, which allows me to aggressive with that size of portfolio, which I've allocated to my options trading. And one clarification that I want to add to that question is it refers about leaps. Now, most of my portfolio is not buying leaps. It's actually selling leaps. So when I buy something, it goes up. One way to take profit for me is that I just sell a leap call on it. And if it gets exercised, I let it be. If market comes back down, then I buy the leap back. So that's what I do with leaps. I don't really buy a lot of leaps. I buy leaps with like single-digit % of my portfolio.
All right, the next question is for Steve, I guess. For Flyagonal, how the results be if no adjustments done and if traded as set and forget with 10% take profit and 3DT before expiry exit? Do you suggest it if one does not like various adjustments?
I would say no. And I did actually run a test like that through AI. I had it take all of my positions and say, if I never adjusted them, where would they be 3 days before expiration? And unfortunately, as strong as the results in this trade are, it can't take, if you're taking profits at 10%, which is going to be a couple $100 at the size I'm trading on a one lot of SPX, and then a loss can be $2,000. I mean, you've got to have a lot of trades to make up for those couple losses on those big move days. So I would say no, I would not recommend that. And the adjustments, once you learn to adjust, and I see the next question is about tools to use, which I'd love to be able to show when we get to that. That's the key. I think in any options trade, if you're going to be an options trader, you need to learn how to adjust.
Yeah, there is the question from Horch Thompson here. I guess that's the one you were referring to, Steve? No.
I think it's the one that Pete Isaacson has there.
All right. So let's take the question from, I don't know how you pronounce this name, but hi,
Jorge,
Steve. Yeah. You mentioned that around 40% of your trades have required adjustment. I'd like to ask about the types of adjustment or roles you typically make in those situations. If you could please describe them. In particular, I'm interested in how you handle them with the price drops sharply, affecting the put diagonal, or rises quickly, impacting the.
And I killed two birds with one stone here, and I'll show you the tool that I use, which is what Pete's asking about. And at the same time, I'll show an adjustment.
Mm-hmm.
So let me just, this is the tool that I personally use called Option Trader's Assistant. I found it by far to be the most stable platform out there for options traders that that allows you to make adjustments. So these are some different trades that I have open right now in my class with students. And let's just take this Flyagonal right here. I'm going to open this up. And what this does is it shows my exact position. So you can easily see right over here, you can see that I have on that broken wing butterfly. I'm not sure why my drawing tool. Here we go. I've got on this broken wing butterfly here. I've got on the diagonal here. This is the diagonal part. This is the broken wing butterfly part. So it's easy to see all that. And it's also easy now for me to model an adjustment. I would not adjust this yet, but let's just say I wanted to flatten my deltas here a little bit. I could come in here and model different ways of flattening my delta. Like maybe I want to sell one here and buy one here. So I just simply come in and click those different places. Yep, I didn't sell the one. And I can model, rolling that. Assuming I could type here, we'd be all good. So I can model various adjustments here. Where do I want to roll this down to, or what do I want to do that might shift my delta in a different direction? So it's very easy in this particular case for me to not only track this trade, but to model how I might want to shift my deltas in the trade. And the other key factor here that you don't get in any brokerage type of connection is this is keeping track of all of the P&Ls along the way. And what I mean by that, if I came in and look, every adjustment that I made is all built into the overall P&L chart I'm seeing. So this keeps track of the fact that I opened the trade here, I adjusted it here. And every step of the way, whatever my profit number is, any opening or closing legs that I have are included in that. So I think the goal there was to basically answer two questions at once, show how I personally track these things and manage my trades. And I may have 40 or 50 of these open at a time. across multiple different accounts. And they're pretty easy to keep track of this way. And then you saw how I would make an adjustment if I needed to make one.
Very, very good. And adjustment, I think, is a very big topic and a topic many people wonder about. So maybe Ravish or Simon, do you have anything to add about your way of adjusting these trades?
I can mention it briefly. The way I trade it is a little bit different to Steve in that I don't have as many adjustments. I can't remember how many I've done this year. It's 5 or 6 perhaps, or 4 or 5 over the year. Not sure why. It's just sort of the nature of how it's constructed. But of course, you do need adjustments, and it's all about the delta for me. So obviously, when the market, say, dumps down, it's really low. All of a sudden, your trade now has this massive positive delta. You want the market to go back up, and so this is where just being a good trader and having a few tools in your toolbox, like a tool, actual tool like Steve was using, or just knowing a bit about trades. Like if you know you're in a situation where you really need the market to go up, you need to add some negative deltas into your position to try and balance it out, right? So as we know, for example, put diagonal is a negative delta trade. So for me, if the market starts dumping down, I might put a calendar or a diagonal below even further down, right? And if you model that in a tool like what Steve was using, or option strat, you can then get a different kind of curve, and so you can try and do it that way. Sometimes I'll put it doesn't happen often, but I'll put an adjustment on, and the market just rebounds back up. What was I thinking? But of course, you don't know what's happening. It could have just is the market going to keep
None of us
going
have
down?
ever done that.
Yeah. So what I'll do is sometimes I'll buy a protective, calendar or diagonal. And for example, the classic one for me this year was the Liberation Day announcement. Trump was saying there's going to be big news, Liberation Day this Friday, and everything I read online said this is going to be awful. So I just bought a calendar 5% below the market price as an insurance policy. And if the market flew up, I would have just sold it for a loss. And that might have meant the overall trade for the week ended up as a loss or a small profit. But the point is, it's an insurance policy. Turned out the price swung exactly into the middle of that calendar. 5% was the drop. Who knows why? And there we go. So that's what I like to do. So it's all about delta to me.
What about you, Ravish? How and your adjustments of your double calendars?
So my strategy, in my strategy, I do adjustments on less than 10% of my trades. I try to avoid adjustments. If the trade is going out of the range, I look at a couple of things. If it is in profit, I take profit. If it is at a break even or a small loss, I cut it and move on. If it is in a big loss, then I can try to roll it out or make an adjustment. But most of the times, I'm out of that trade before it gets to that point. So my thought process is that earlier I used to be like that. I should not let every trade get away. I will make adjustment and I'll chase every trade and turn it profitable. But that often increases your risk and stress level. So what I've now decided to do is that I don't have to fight every trade. Sometimes it is okay to take a small loss and move on to the next trade. We don't have to fight the same trade. We can make the money back from the next trade. So we just move on.
Thank you. We have a question from Jill, and I don't know who this is directed at, but it's very clear. More specifics, please. DTE, delta, width of spread, and butterfly, etc. Anyone feel like going more into the specific than what you already said?
Yeah, I don't mind sharing.
Steve.
So, and I think Simon is probably close, but he can correct me if he's got a different way of doing things. But for me, I generally start my call broken wing butterfly at 10 to 20 points above the market, and it's a 60-50 broken wing butterfly. I have found through analyzing it with AI that the best results that I'm getting as far as my shortest time in market, best amount of return, has been in that 7 to 14 day window is my expirations on the bulk of the fly, and then the bulk of the Flyagonal. And then for the diagonal part, I'm usually going anywhere from 20 to 30 points below the market. And all of this is in SPX, by the way. If I do this in Apple or something else, obviously I have to adjust it. But 20 to 30 points below the market for my short, and then my long will usually be about 3 to 7 days different. I think Simon uses 7. I use 3 predominantly. And I'm going 10 points below on that. So that's my normal structure in SPX for the Flyagonal. And as Simon already pointed out earlier, that can vary if volatility is higher. I have the opportunity to maybe spread my range out a little bit.
Anyone else would like to add something?
Yeah, I can comment. Yeah, so the actual position of the two legs or two components, like I mentioned, is basically due to volatility. But the actual widths for me, and to be fair, and people who followed me know this, I don't look exactly at delta, although delta would be a great way to trade this, because if you go, I'm always going to sell it, I don't know, 20 delta, whatever, put, then when volatility changes, that moves naturally, right? So it's a nice way of just, you know, I just try to have a more of a feel for it. I like the fun of trying to get a trade that I like, sort of almost manually, maybe just, but I like to adjust the widths such that how the curve looks is what I'm looking for. I'm looking for how the whole shape of the trade is going to look as time moves forward. So that's why each week, and people who have traded this will know, seeing my trades, that the widths are actually different. Some weeks they're similar because vol hasn't moved much, but some weeks because volatility has changed, I might have different widths on the butterfly, different widths on the diagonal, and it really just depends on getting a curve that I'm really happy with how it's going to look through the week as time moves forward. So it's not I don't have an exact scientific answer. So you could argue my system isn't, my trade is not 100% mechanical, but that's how I like to trade. I like to have a feel for it. I'm not just trying to, because if it was mechanical, I could just make a bot do it, right? But it doesn't quite work that way. So yeah.
Would you like to add anything, Ravish?
Yeah, I think in my presentation, I shared like a lot of specific, like picking up the delta and the strikes. One thing that I would like to add is that I was analyzing my results year to date, and it turns out that most of the profits that I've made was actually from call calendars. Now, doing double calendars give us like a peace of mind that we are delta neutral, but put calendars have been actually a net losing position for me year to date. If I just did call calendar with smaller position size, I would have made more profit. So, and another thing now I'm tweaking on that is that if I really want to have a peace of mind of like trading double calendar, I can also leg in and out at different times.
All right, thank you very much. Let's take the next question, which is from Altamash Meri, and to all of you. And I guess it's following a little bit up on what we were talking about. I'd like to know all you guys' take on how to control your position so that delta is always contained within the limits of theta. Basically, how to avoid hitting stops due to small whiplash price movements. Any taker on this?
It's definitely a tough problem. Like people who have been in my Discord server and we chat about this kind of thing all the time, the market will drop. And it's the big question, do I add an adjustment or do I not? Because it might come back up again, for example. And so the whiplash moves are really hard. Like it's really hard to, a big move down, it could be a big move up tomorrow or another big move. So it's, again, if you really worry about that kind of thing, then obviously the adjustments we just talked about, keeping your delta under control, are important. But I think, as was mentioned earlier, there's actually absolutely nothing wrong with taking a loss. You know, if you get to the point where you're near a stop loss or you're negative and you just don't know what's going to happen, you're not confident adjusting, I tell people all the time, there's no shame in going, look, I don't know what's going on here. Just take the small loss, come back again next week and we'll try again. You know what I mean? Like, I'd hate for someone to hold a trade, not know what they're doing next minute. What was a 1% winner or a 4% loser is now a 40% loser because they didn't know what to do. So it's all about your risk tolerance and your experience. If you're a good trader, you'll be confident in putting on adjustments and using tools like Steve was showing to do that. If you're not so confident, take the loss, move on. You can't win them all. It's definitely, a good mindset to have with trading.
There is a
One
question
quick
here.
comment there. Oh,
yeah, sure. Go ahead.
I was just going to say one quick comment too on that. I see that he talked about stops. I just want to say that from my perspective, particularly if you're trading SPX, and I'm assuming also RUT, I would never use a mechanical stop. The bid-ask spreads are so wide. If you go and put a stop in there and you get stopped out, you are going to regret it. So in my case, I don't do stops. I will adjust my trade. And then after the market settles down, when you have a big move, I'll adjust my trade to accommodate the new location of the market, let it set there, settle down a little bit, wait for the bid-ask spreads to tighten up. And then is when I may choose to exit if I'm going to exit. But I would never use a mechanical stop.
Yeah.
Do you use stops, Ravish?
I don't use any stop loss because what I've seen is like with most of my trades, even if they go down, if I hold them till expiration, usually they come back in profit. And also when they are in a drawdown, the drawdown is usually like 10, 20, 30% maximum. They don't really go to zero because we always have the backside of the options. And the other thing that I do is instead of trying to make adjustments, what I do is, let's say I want to open a position and I want to buy 4 contracts. I'm not going to open all on the same time at the same strikes. I will open one on day one, and then next day I'm going to open at slightly different strikes because the price have moved. Then next day I will have another one. That way I can average in and out, and I can have a much wider coverage, so that if one trade goes out of the range or the delta changes, the other trade is going to be in the range. So I'm always going to be able to take profit from one or another trade. That way it kind of smoothens out the profit and loss curve for me.
All right. Let's bring in the next questions that is on the top here now. This is for you, Steve. Yesterday, the SPX dropped significantly and very quickly, causing volatility to rise sharply in a short period of time. Based on what I observed in the put diagonal tent, instead of expanding or providing more protection, the opposite occurred. I believe this happened due to the weighted Vega effect, where a sharp increase in volatility has a greater impact on the shorter DTE options compared to the longer DTE ones. This caused the spread differential to narrow instead of widen. Have you noticed this effect, and what would you recommend in such a situation? And I guess that's a relevant question for all of you guys, not only Steve.
Yeah, since we're all trading calendars, I'm going to be interested in other people's answers too. But I guess the first thing I would say is, yes, I have definitely noticed that. And I will say that, and I get in my class, I get into this, I spend about an hour on it, on how they model, they being a calendar or diagonal, they model as positive Vega. In reality, they don't always act that way. And it's too long to get into here, but there's nuances of when and why they act certain ways. And I think Simon might, mine are normally 3 days apart. So my short put, my long put are usually only about 3 days apart. In that scenario, exactly what this person indicated does tend to happen. It doesn't widen out as it shows on Option Strat or any platform. And that's just a function of the modeling you're using. If you're using Black-Scholes or binomial or whatever, they don't handle time spreads very well. Now, the difference, or a way that you can combat that, is those two can be further apart. If you put them further apart in days to expiration, which again, I think Simon uses 5 mainly, I think you might experience a little more of the positive effect that we would like to see in that down move. But offset, it takes a lot more buying power to do that. So that's where a good modeling package will be able to model up those differences for you. Then you can choose what works best for you. So that's my answer, but I'm going to be really interested in these guys' response to that, because yes, I have experienced that, especially when they're close together in time.
What have you seen, Ravish?
So what I've seen is that usually when we have an increase in VIX, Short dated calendars, they don't do well because implied volatility for your front date goes up higher than the previous, the backdated one. But if you have more time, if your calendar is like at least 1 to 2 weeks away, then you are going to see a positive impact. So yesterday, some of my short dated calendars were in negative, longer dated calendars were doing well. So that is why you see that it's not just as simple as volatility going up, because IV is different for different dates. So you have to see the volatility term structure. You ideally want the volatility for back date to go up more than the short date, or at least move in the similar ratio.
Simon, would you add something?
Yeah, no, just everything that Steve said, because yeah, the platforms we have for modeling, it's really tricky to get the exact, because you can't even predict how the volatility will change between the two different dates. You know, you can sort of do an average or have a play. So I've seen it. It's very hard to combat, and like everything Steve said, if you want to have a bit more, I guess, stability with the trade-off of the buying power, then of course you change the time. So it's a matter of getting that trade-off. What's important to you? You know, do you want to manage that, or do you want to have less buying power and maybe take the risk of a loss? It's a bit of an art, to be fair. These time spreads.
And on tools like OptionStrat and Thinkorswim, sometimes you'll see like a trade which has like 80% probability of profit. It is going to make profit no matter what. Or sometimes you see that there is like 0% probability of making profit with a time spread. That's not accurate at all.
No.
That is because of the volatility skew. And that is not an accurate representation, which is why I kind of like not completely trust it. I look at my model in a different way that, okay, where I see the volatility going, I am looking for the backdated premium to go up and short dated premium to decay.
We have one question for you, Ravish. You said on the video interview we did on double diagonals that the return on capital per month is 20 to 30% per month. Is this based on 1 or 2 trades per week? What goes into this? How many trades per month do you place, and how many trades are open at one point in time? Do you overlap many trades on SPX, or put the same trades on multiple securities like QQQ and others? Quite a few questions for you there.
Yeah, I can. It can vary depending on the market condition. So if I'm doing a directional trade like calendar spread or a put calendar spread, my position size is going to be smaller, and those I can do on individual tickers as well. So what I like to do is that either I can do a double calendar on something like SPX, or I can do a call calendar on a stock where I feel bullish, and a put calendar on a stock where I'm bearish. That way I have a double calendar, but split into 2 different tickers. And that is also one way to do is if I try to do double calendars on individual stocks, the spreads are too wide, it's very difficult to get fills. And usually in terms of position size, uh, I'm trading 5 to 10% of my account on each trade, which can be split into different strikes and different dates also. And I usually have multiple overlapping trades. On an average, I open 2 to 3 new trades every week. And at a given time, I might have 5 to 10 active positions.
We are running out of time, so I think I'm just gonna take one more question before we start summing up. And that is from Alex, wondering if anybody uses any data, for example, VIX 1 day, VIX 9 day, to understand expected moves in SPX.
I feel like for Simon's and my trades, and sounds like Ravish's too, that because we're dealing with such a wide range that our trades cover, I don't see the value in it for me personally.
Yeah, I'm the same. I use VIX as a general purpose. How volatile is the market? How wide will my spreads be? Other than that, I'm not getting down to that lower level of all those extra data points you can look at.
I look at
sorry, Rash, there you go.
Yeah, I look at the volatility term structure of the individual dates. So whatever dates I'm picking, I look at what the IV is for those specific dates, and if that provides me a good setup.
Looking for backwardation. Oh, well, you're not going to get backwardation in most cases, probably, right, Ravish? But at least looking for the volatilities to be as close to backward as possible.
Yeah, ideally something like that, or I'm looking for some type of skew where if I have like higher volatility on the back date, even that can work
Okay.
because then the front date is going to decay faster because it has lower volatility. But if you model that in option strat, it is going to say it has 0% chance of making profit.
Yeah, I don't trust those percentages. Sometimes I put my Timeflies Spread on for the week, and Tasty Trade says the overall trade has an 8% chance of profit. It's like, what? It's almost the
I
opposite.
think let's take a short round of summing up, and then I will also encourage all the audience to also use the YouTube chat to give some feedback to the speakers here while they sum up. That's also always nice to get. But let's sum up a little bit what is the most important takeaway from this event in your opinion. Would you like to start, Simon?
Sure. I think what could you take away? Well, definitely with my strategy and Steve's strategy, I think learning about how Delta and Theta can work together with these different strategies to make a sort of a strategy that's greater than its parts is quite interesting. And I think it just gives people a chance to think about some of these strategies. A lot of people just like to copy other traders and just do what they do, but I'd really recommend people use tools to understand how Theta and Vega really affect stuff. And I think all three of these trades, it's really important to note that Steve mentioned, these are all defined risk trades, which is a perfect thing for someone getting into options trading. Maybe if you're just a beginner getting to the intermediate stage and you want to try something a bit more complicated, you don't want to wake up, there's been some massive vol spike in your accounts, negative 30K or whatever, right? So this is a good place to experiment.
What would be your takeaway, Ravish?
I think there are a lot of ways to make money in the market. Everyone has their own strategy, and they are all profitable. So you have to find something that works for you, that works with your lifestyle and skill level, and focus on mastering that strategy. And you don't need to trade anything and everything. Some people are trading 50 different tickers, 10 different strategies. That way, you are going to overwhelm yourself and you are going to burn out. So what works best for me is just focusing on a couple of strategies and just do them on repeat.
And Steve?
I love what Ravish just said, and I think that's a takeaway for everybody listening right here. Each one of us has honed in on something. Simon and I have honed in on something very similar. Ravish has honed in on something, and we've become kind of a master at those specific trades. I'm that guy that Ravish just mentioned, that I used to trade everything, and I traded it in every direction. And I drove myself nuts. And I would sometimes have a good month, sometimes have a bad month. And there was never any consistency. And so, gosh, probably 14, 15 years ago, a coach I had at the time said, Steve, you're all over everywhere. Pick one thing and focus on it. I picked the broken wing butterfly to focus on. And I focused on that until I nailed it. I knew exactly how to trade that. That's why I did my class on that. Then I brought in calendars and diagonals to supplement it. And then that's when I realized, like Simon did, those two need to be married. And it is a more complex trade, like Simon said. Do not come in here as a brand new options trader thinking you're going to trade Simon's Timefly or my Flyagonal if you've never done broken wing butterflies or calendars and diagonals before. But we offer ways for you to learn how to get there.
Thank you very much. I really appreciate you guys coming here and sharing. I have put up another live poll in Vvox that we are not going to show here, but it is. But you can use it to give feedback to me and to suggest topics for the next session we will have. I do plan to organize, hopefully, at least one more Theta Live before Christmas. Steve, Simon, and Ravish, thank you very much for joining and for sharing your knowledge and answering all the questions. And I'm sorry we didn't get through all the questions, but I think 1.5 hours is probably a max time frame we should use. So thank you very much for joining.
Thank you to the fellow contributors here as well, John, and for you to hosting us.
Yeah,
it's been-
thank you,
it's been
John.
fun.
Thank you, Steve and Simon. It was a pleasure speaking with you all.
You too. Thank you, guys.